Hi, have you ever tried to predict stock market based on historical data, looking at some graphs and then detecting patterns? If so, let's look at what we learned from chapter 3 of The Intelligent Investor. It's very important to know the history of stock market so that we know what we are getting into. History educates us on a lot of things, and it's important for prudent investors to get a good idea of like what has happened in the past. How does the stock market behave during depressing times, during euphoric times, etc. And so it's very good to look at historical data to educate oneself, because a lot of time those cyclic movements happen even in the current times and will expect to happen in the future. So, if we have this historical context, then we will have some worthwhile judgment of the dangers when it comes to predicting stock markets. What I have learned and concluded from this chapter is that there are a lot of fluctuations, as big as 30%, 40% fluctuations in a single year. So if you invest $100, it could go down to $60, it could go down to $40, and at worst times it can go down to $20. So huge swings are expected in the stock market situation if you invest in stock market. And at the same time, if we have this perspective, we will be humble when we go about investing in it. The other key learning for me was look at looking at just the stock prices, it's not enough. Looking at the company's earnings, its growth in terms of earnings growth, dividend growth is equally important. So let's not only look at stock prices in isolation. The other key learning was systematic investment over 1 to 2 period may not be sufficient, because there are many times when the investments would have taken 5 to 10 years to break even. So some sort of consistent investment pattern that you can follow for 10 years, 5 to 10 years, will help you sleep better, will help you win over the long term with stock market based on historical data. And there will always be momentum that will either drive the stock market to heights that are unimaginable, unjustifiable. At the same time, there will always be pessimistic times where there's serious losses, highly depressed prices, companies trading at a very low price to earnings and doing really well. So going long is probably the best way. So that is the key learning. Going long and also doing it in opposites. Like how can we be more aggressive when everyone else is um, pessimistic? How can we be more humble and how can we be more conservative when everyone else is highly aggressive? Those were some of the learnings, and there are three principles: is to never borrow money to hold or buy securities, because you never know, the prices can correct in a big way. Do not increase proportions because prices are going up. Instead, regularly rebalance, and at least once a year need to rebalance and sell profits. Pay income tax wisely with grace, and the proceeds should be rebalanced into high grade bonds or cash or savings account. So at max 50% is a prudent, most aggressive investment, versus 50% bond and cash was the key learning. So those are three key principles from Graham. And this was another important analogy. So a mathematician is uses proofs and is quite, it can he can actually use formulas, he can come up with logic, and it's sound and it can be repeatable. An orator at a election rally will be on the other extreme, will promise things that are um, highly, castle in the air kind of a situation. And so financial analysts or people who try to predict stock market, especially on a day-to-day basis or a weekly basis or a monthly basis, they're somewhere in the middle. So that is the kind of humility that we need to have when we come into this area of stock market prediction. We should understand that almost all of them will never always be true, and it's very hard to predict. And history, although has patterns, but it's very hard for those patterns to repeat. So take it with a very, light input, or maybe even ignore input from analysts. That was the key learning. And definitely don't try to predict, because there were so many examples in the third chapter which prove time and again that Graham himself had a hard time predicting carefully and decisively all the time. So he also advises a lot of humility. So be humble. It's very hard to extrapolate the future from the past. And anyone who claims that the long term record proves that the stocks are guaranteed to outperform cash or bond is ignorant. Is That was another big learning, because I thought stocks always outperform bonds and cash. That's not true. It's like, what price do you pay for? When do you get in? It's very important angle, and that is true. We'll see in some of the graphs. So price is very important. So Michael Jordan gets what was paid $34 million for every season, I believe, and that was the price. But someone could think, oh wow, that's a lot of money. How could you pay that much? But he was not paid $340 million. He was not paid $3.4 billion. He was paid $34 million. He could pack the entire stadium because of how good he was. But that was a fair price. Seems like a bargain at this moment, but that was a huge money. So price is very important. And as I said earlier, rule of opposites, when there's utmost pessimism, you need to have the money and the patience to be buying at that time. So if you can't, then that's a problem. So invest in SDP, but invest with longer time duration, more than 3 years, if probably 5 years. 6 to 7% based on calculations in the book, 2% earnings growth to 3% inflation and 2% dividends is the expected growth that you can expect from stocks, and that's adequate return. If you try to get more aggressive from it, then you are getting into the greedy zone. Robert Shiller's index is another good proxy that has been developed in the recent times, which predicts some sort of euphoria and pessimism in the stock markets. These two lines really summed it up for me. Blessed is he who expects nothing, for he shall not be disappointed. Or blessed is he who expects nothing, for he shall enjoy everything. So expectation is the key thing here. Like, we expect our investments to grow, but that is what causes all the issues. So no expectation, and figuring out a formula for yourself where you can sleep well, where you can still invest a lot of money that you have, but with adequate return in mind, and constant rebalancing is the key. Look at this chart. From the 1930s to all the way 2018, we see big dips, close to 40%, as early as recent as 2008. 40% drop year 1 year, 40% drop. And then there's 1930s, you can see 46% drop. So there are huge swings in the stock market. So if you think of the short term, then you are going to lose a lot of money. So you got to have at least 3+ years of horizon. And if you look at this graph overall from 1950s, things have been going up. But if you invested here and started aggressively investing in 1999 and 2000, then you'd probably take all the way till 2014. So 15 years, you would be net neutral in terms of stock prices. So 15 years of no growth. At this point, you could say in this 15 years, if you had invested in bonds, you probably have done much better. So if you stop investing, that's a problem. So you got to have a lot of time in the market, not timing the market, time in the market, and you need to invest for the long period. But if you do that, then you're expected to gain a lot of return as the stock over time goes up. But that over time is at least 10 plus years of horizon. This is the Shiller P index, which is updated on a day-to-day basis. And I think the formula there is that if it's above 20, then it's in a very euphoric zone. And if it's below 20, is when is the right time to invest. So these are all available data points. And so again, summarizing my key learnings, the key changes I'm going to be doing is at max 50% of my allocation will be in stock, and I will start to rebalance mid-year every year. So current proportions are out of whack for me. I have to get back to at max 50%, even if I'm in the most aggressive. And current market situation, based on how many years of bull market we are in, I feel this is already too aggressive. So at max 50% stock, and increase my current capacity with the current funds that I have to be able to invest 3 years at the minimum if I'm super aggressive. But I'm going to change that to 5 years to be conservative given how I feel about the markets. Don't watch the news, don't watch the forecasters. We just learned there are going to be these big swings. Have utmost humility. Definitely don't try to forecast the market, and go long and have the capacity to stay in the market and sleep well. That is the winning formula, and these are the key learnings for me. Thanks.